So today I wanted to talk about mortgage insurance. I know it's a dirty word, a four-letter word to some people, but it's not as scary as you think. There's a big myth that you have to put 20% down to get into a house. And while that is a good strategy, it does prevent a lot of people from getting into the housing market and being a homeowner. As you see from the slide, there hasn't been over 20% down since as a median, meaning half the down payments have been more than 20%, half have been less. It hasn't been over 20% since 2005, and that's before the crash. So again, 20% down is a misconception. I wanted to dig a little deeper into that. If you look here at this chart, first-time home buyers, the median is 7%, all home buyers is 12%, and repeat home buyers is 16%. And the important part there is, even if you're not a first-time home buyer, if you're doing a move-up especially, you don't have to wait until you have that 20% down. But if you are a first-time home buyer, there's a great resource for down payment assistance. It's called downpaymentresource.com. You can check that out. And this whole slide, this will be posted, so I don't want to go through everything. I'm just going to give you a cursory view, dig deep in some things that I think are important. So one of the things I wanted to go over is what's the time period that it takes to get the down payment money. And this is a chart, and this is from HUD, the Department of Housing and Urban Development. What it's saying is nationwide, if you wanted to put 10% down, it takes about 2.5 years. And then even going a little bit lower at 3%, it's just under a year, like 9 months. And the big thing about that is mortgage insurance. And there's several types of mortgage insurance. The one that most people know about is the monthly mortgage insurance, which happens when you don't put 80% down. But the other two that a lot of people don't know about is what's called lender-paid mortgage insurance, which is essentially building the mortgage insurance into a rate, meaning a little bit higher rate. And the other one, the third one, is a one-time borrower-paid mortgage insurance, where you're essentially buying out that monthly mortgage insurance with a one-time payment. And what are the differences in the three? As I mentioned, the monthly mortgage insurance is going to be the low rate, and it's for people who are sensitive to rate and sensitive to down payment. They just don't have the 10, 15, 20% to put down. And what's important, and the big caveat of not putting 20% down, is can you afford the payment? Now, on my end as a mortgage advisor, we have limits that Fannie and Freddie give us on a conventional loan. You don't want to go over 41%. You can, but I like to see 30%, and that debt to income ratio is taking your gross income and factor in not just the housing payment, but whatever credit cards and car payments that you have. So with the monthly mortgage insurance, it drops off when you get to an 80% loan to value, which happens with the combination of paying principal and the appreciation in whatever neighborhood your home is, which is an important factor, because if you're in a really good market, a hot market, that could drop off in 2 to 4 years. And I'm going to show you a side-by-side comparison here in a little bit. The lender-paid mortgage insurance, as I mentioned, it's going to be a higher rate, but it's going to be a lower monthly payment because you're not going to have that monthly mortgage insurance. This is for the person that's sensitive to the monthly payment. And I don't use this a lot. I'll use it when someone's really butting up against the high debt to income ratio to qualify for the mortgage. And if you do the Lpmi and it gets you under and it qualifies you, that's when I'll use it. But it's a short-term fix. And mortgages now, no one stays in their mortgage 30 years. If you look it up, historically, people are in their mortgage 4 to 7 years. That bumped up a little bit after the crisis, but if you just think about anyone in your circle, if you own a home, or even if you're first-time home buyer, it's a good time to ask questions. How many times have you bought or refinanced, and you'll see that the 30-year mortgage is a tool that you use because this is going to be the lowest payment. And then the third, borrower paid. It's also going to be a low rate, just like the monthly mortgage insurance, but you are paying more in closing costs to buy out that monthly mortgage insurance. And this is a good program, a good option for someone who is rate sensitive, wants a very competitive rate, but they're also not down payment sensitive like someone would be in a monthly mortgage insurance. So those are the differences. And I wanted to do a scenario. This is something that I'll do with a client. Here in this scenario, it's a 5% down, which used a $250,000 sale price. So that's $12,500 that for the down payment. It's a single person and then 22% tax bracket, which is the $40,000 to just above $86,000. They're currently paying about $1,500 in rent. They have $30,000 for their house fund. That's savings, retirement, a gift. But I'm very adamant about, I don't want that $30,000 to be all you have after the deal is done. So when I say $30,000 house fund, that means $30,000 you have to play with, but you're going to have more left over in your checking or savings account. And then the last assumption is a 720 credit score. So this is what I will do with my clients on their, this is like a conventional 5% down, because this kind of covers a lot of different the profiles, borrower profiles. You see in the first column, I have the rent, and I had the assumption of a $1,500 a month rent with a $25 a month renter's insurance. So that's why that's $1,525. Obviously, when you're renting, there's no advantage because you're paying someone else's mortgage. And the second column is the monthly MI scenario. $250,000. All of them have the same sale price, same down payment, same loan amount. Interest rates are different. With the monthly MI is 3.375, which is a little higher than a 20% down. But again, if you don't have the funds, there is a positive trade-off if you don't have the funds, because you're going to be a homeowner and you're going to be almost immediately in most markets gaining equity as a homeowner, and you're not paying someone else's mortgage. The $1,469 is the monthly payment. The tax benefit, $147, because there is a tax benefit to owning, and principal paid. And I use the 10-year snapshot for this, and your net monthly payment. So just going down, the lender paid, that's, as I mentioned, a higher interest rate, but the payment is lower by, what's that, $54 than the monthly MI, because there is no MI when you do lender paid. Again, this is for someone who may be bumping up against the qualifying debt to income ratio. This is a way to get under it. Temporary fix, and that's why I said short term. You don't want to be in, especially with the rates being as low, you don't want to be in that high a rate, relatively speaking. And then borrower paid long term. This is paying an upfront fee. In this scenario, I'll show them that to buy out that mortgage insurance, it was like $5,300, almost $5,400. So there's reasons for choosing each one of them, and let me go over that real quick. When would your monthly MI drop off? And that was the second column right here, monthly mortgage insurance. I went through and said, what's the break even between what the house is going to appreciate for, and I use 4% appreciation, which historically 6% appreciation in home ownership, but I want to be conservative when I'm consulting. So 4% appreciation and paying down principal in month 30, in between month 35 and 36, so just under 3 years, is when that mortgage insurance would drop off. I always advise clients that they want to get an appraisal done every 2 or 3 years just to see what the value of their home is. If it's a hot market, this number could be as low as 24 months. You just don't know. But you want to go in with a conservative guesstimate of how long you're going to have that mortgage insurance. Some banks, it'll automatically drop off, but I never leave it up to the banks to do the right thing. So I always suggest, and I do annual mortgage reviews with all of my clients. So we would have had at least 2 consultations about where your mortgage was. And then when it gets to that 80%, you just call up the bank. You have an appraisal done, call up the bank, show them the appraisal. And if they haven't already dropped the mortgage insurance, they will with an appraisal showing that what your principal is and showing what the value of the house is. When would you use Lpmi? As I said, it's usually when the debt to income comes into play. It's a short-term solution. And this one is, I'll keep track of where you are, where the rates are. Someone, if they bought right now, in a year, the rate may be bumping up against that 3.625, but it also may be still 3.25 to 3.375. And it just everybody's loan is different, so it just varies. But that's usually when you use the Lpmis, when you're trying to qualify debt to income ratio wise. And then when would you use the borrower paid mortgage insurance? Because 10% and 5% down is not a huge difference, if at all, in interest rate. Just buying out, as I mentioned in that example, it was like $5,375. Buying out that monthly mortgage insurance is a much better, it's considerably less than having to put an extra 5% down, which would be 25,000. So you're talking about a difference of between $6,000 and $7,000 that you get to keep in your pocket for furniture, painting, anything that you want to make the house yours. And remember, in this example, the break-even point would be 5 years. The borrower-paid mortgage insurance is more of a long-term. If you think you're going to be in your mortgage more than 5 years, be in the house more than 5 years, that's the one to go to, because the difference in the payment, which is about $87 from the monthly mortgage insurance, which would be another option that I would look at with a client. This is what I wanted to also show is with the money that you're going to be with the side-by-side comparison, both the monthly mortgage insurance and the borrower paid, you're going to be putting in about $23,000 total. I'm sorry, with the monthly mortgage insurance and the lender paid, you're going to be putting in about $23,000. With the borrower paid, it's going to be closer to $27,000, $28,000 in down payment money. If you have $30,000, this would be the sweet spot to evaluate all three side by side. So there you have it, the difference between the monthly MI, the Lpmi, and the borrower paid. If you have any questions, you can always reach out to me, and please feel free to like, share, follow, and subscribe. Have a fantastic day.